Good morning, good afternoon, and good evening, everyone, and welcome to Demystifying Startup Valuation with Kemp Moyer. My name is Colin Mahan, and I'm the Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you may have just seen in the chat, the Nasdaq Center, along with our partner Mentor Cloud, launched a free mentor matching platform for entrepreneurs called Mentor Makers. You can create your own advisory board to guide and inspire you with in-the-moment mentorship from topic experts and professionals dedicated to providing exceptional mentorship to entrepreneurs across all races, industries, and geographies. So find or become a mentor today by using that link in the chat. Speaking of the chat, quick housekeeping item. We're going to open up for live Q&A near the end of the event, so please submit those questions for us in the Q&A function at the bottom of your screen throughout the presentation. We'll try to get to them all. Now, none of what we do here at the center could be possible without all of the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, BPM, and HubSpot. We're grateful and humbled by their contributions. Now, during these still very unique times, we're curious on how sentiment is among the entrepreneurs that we work with. So before we jump into our session today, I'm going to launch a quick poll just to let us know how you're feeling about your business today. Are you optimistic, in survival mode, feeling a little anxiety? Let us know. We measure the sentiment to understand the wellness for entrepreneurs courses that we should be offering to you, the entrepreneurs we serve. I'm going to let this roll for another couple of seconds. Thank you all for participating. All right, I'm going to end this and share those results with you all. Looks like optimism is in the lead, which is a good news, but understand that there's a little bit of anxiety, survival mode, and fear out there. So hopefully our presentation today will help alleviate some of those negative sentiments. So without any further delay, please join me in giving a warm welcome in the chat to our special guest. Kemp Moyer is a partner at advisory at BPM. Kemp, welcome.
Greetings. Thanks for having me, Colin. Really appreciate the opportunity to be here today.
Stoked to have you back and looking forward to learning more. Over to you.
Absolutely. So yeah, I'm going to share a screen, get in. Really appreciate everyone who's joined today. My experience with the Nasdaq Entrepreneurial Center is it's a global audience. So I hope we have many geographies, many countries, all backgrounds represented, and really fantastic to speak with you all and hopefully share some insight that will be beneficial to you as you keep doing what you do and building your businesses. So let me share a screen here and bear with me if it takes a second. You know, I'm not the, there we go, not the tech expert. You know, that's why I love working with entrepreneurs. They help figure out all that stuff that I'm not good at. So here, what I am somewhat good at, some people tell me, right, is valuations. So I'm here to speak a little bit about demystifying startup valuations. You know, fantastic to be here again with the Entrepreneurial Center. BPM and Nasdaq have a long-standing partnership, and it's really fantastic to get the opportunity to speak to budding, rising, emerging, growing entrepreneurs across all fields. Before I get in a little bit to the content, just a little quick, who are we at BPM? Ultimately, BPM is because people matter. We're an advisory and accounting firm, now top 40 US, but we're focused on the success of our clients, colleagues, and the communities we are within. We believe in fostering success in work and life. You see some facts there. We're definitely a Bay Area, you know, born and rooted entity. But at this point now, we were up to having, you know, post-COVID, having individuals in all 50 US states. But really, again, are focused on fostering the success and work and life for those that are a part of our firm, our clients, colleagues, and the communities that we're focused on. So we love to be associated with the Nasdaq Entrepreneurial Center because that's truly aligned with our mission. A little bit about me. I'm a partner here at BPM, recently elected to the partner group last year. So really excited about that. But I have about 15 plus years of business valuation experience. Again, I've been Bay Area, California based for my whole career. I'm actually a Bay Area native. Not as many of those around these days as people kind of come and go. But my experience on the business side is effectively growing into impacting high impact valuations. So IPO, SPAC preparation, M&A, both pre-deal and post, buy side, sell side, minority investments. So that might be shareholder buyouts, that might be Series C through Series F fundings, litigation support, tax and financial reporting purposes. I'm a business valuation guy. If you have a business valuation need, I've probably seen it. So little technical details: certified valuation analyst, certified manager of quality, organizational excellence. I was a member of NACLA's 2020 40 under 40. A little more interesting tidbit: I did coach high school football as well for 15 years. So again, being able to be a part of these presentations and speaking with the Entrepreneurial Center, it definitely, the mentorship that was highlighted, with the mentor makers really scratches the itch for me of seeing people grow, develop, achieve goals, etc. So if you hear some kind of coach speak from me, that comes from a background, and I really, there's nothing more that I love than combining, my valuation professional expertise with my coaching background. So hopefully you learn a little bit from this today and can carry that on to be just a little bit more successful in your work in life going forward. So in terms of the content at hand, right? Demystifying startup valuations. There's a lot of missed, right? The earlier stage you are, the less metrics you have, the less data and numbers, kind of the more challenging it is to put a number on your business, right? So there is a lot of missed there. And when there is missed, we want to kind of step back and kind of simplify, right? So business valuation in the big picture, this is a very simple summary, right? Always remember this, and this goes up all the way to Apple, one of the, I believe they're the largest company in the world. But enterprise value, right? The value of your company, the total pie. It really is a simple equation, and that's perceptions of future cash flow of your business divided by perceptions of risk. Perceptions of future cash flow, perceptions of risk. If I could drill in one thing, it's that is your business. Your business is not based on the past, although the past tells a story. Your business value is based on the perceptions of the future, right? And it's based on the future, but no one knows what's going to happen in the future, so it's based on perception. Confidence in your business, confidence that risk will be minimized. The more you create that confidence in those two pieces of the equation, the better. So boost cash flow perception, reduce risk, values going up. As you can see here, the perception is a critical component of valuation. So, we're always trying to be able to tell a story, right? Tell a story that's believable, that matches the facts, that an investor, someone that has capital, is going to place that, hard-earned capital under your management, right? So we want to be able to tell a story that's comprehensive, that matches the numbers and the qualitative side fit together, right? And we want to be able to make that believable that any investor would buy in, right? You want them to buy in. You want participants to be a part of that process. This simple equation can help navigate not just a raise, right? Not just going to market or a sale, right? In the future, the sale of your company, but the overall business strategy, right? So understanding kind of that fundamental can help you with developing success operationally. And then again, that'll beget a higher valuation, right? So it's kind of you want to create that virtuous cycle. So again, it's a very simple equation, but one I would tell any entrepreneur to bake into their mindset, not just kind of on a quarterly analysis, but literally day to day, right? This should be a part of the DNA of you as an entrepreneur. I'm not going to get too technical in this because, that would, probably bore everyone to sleep if we got into very nitty gritty of valuation mechanics. And I could do that, but I don't want to do that. So, but I will speak to the kind of traditional buckets of valuation, and every finance company on earth that really operates will understand these methods and utilize them. So these will be the mechanics that are put into play as investors or buyers or investment bankers analyze your business or any business, right? So, kind of three buckets. One, you have the income approaches. And when I say here, think projection, think your discounted cash flow method, right? The future projection, capitalization, and cash flow method. That's more for a steady state company. Hopefully, all of you guys are, headed upward, guys and gals, right? And at the cash flow method, capitalization, it's kind of more flat. So I know there are some mature companies probably out there that are still looking to, do their thing, but we're all growth stage, right? So upward trajectory, discounted cash flow. Market approaches, right? Think market multiples. I find that this is usually, the most commonly easy to pick up, and it's really applied multiples, right? Guideline public companies method, guideline transactions method. We'll get a little bit more into this for your particular cases a little bit later in the program. But certainly having that understanding of how the market is pricing out, similar companies. I know the earlier stage you are, the harder it is to find that comparable, right? Because public companies are generally much more mature, larger, right? They've been through the process, transactions also. So while this can be used, absolutely, it can present challenges for early stage companies. But also, transactions of the company's own stock. If you have had any transactions, whether that be preferred round, angel, selling some stock to friends and family, that will create, certain stake in the ground in terms of valuation of the company and the equity. So just something to be aware of there. And then asset-based approaches. This kind of think if an investor built it themselves or a buyer, right? Sometimes we do see, I have a client right now where they were acquired or they're in the process of being acquired after their seed stage. And it's a technology company in the gaming space. So very early stage, but they are being acquired by a strategic acquirer. And, there's not a lot, they're pre-revenue. So the acquisition is on the strategic buyers saying, okay, we're buying you because rather than us hiring people, building it, taking the time, delays, the amount of time that we take, we can buy you and plug you in, right? So that's kind of a replacement cost method. So fortunately for this client, they've been able to kind of lever up additional layers on top of just, okay, the dollar investment it would take, right? You have time acceleration, there's value in time, et cetera. So synergies, things like that. So this is one, you don't really want to be valued on an asset-based approach as an early stage company because it's generally not going to maximize the value, but sometimes it is in very unique situations, right? Strategic investors that want to plug in your technology and do it fast and do it now, it can come into play. But no matter what, bottom line there at the bottom, developing reliable data and a believable story helps with every approach, right? So again, big picture, it's creating that perception, confidence, right? Developing a story that matches the numbers, being able to present the numbers, being able to back them up, et cetera. One core issue, right? Valuation. So your valuation, does it matter day to day? Maybe, maybe not. Not really. Your valuation really matters when you go to market, right? When you're raising funds, when you're entering a potential M&A scenario. In the future, when you have a public situation, the SPAC window opens up and you might be able to go out, right? So the valuation matters most when there's a meeting with the market. And when you meet with the market, there's often an issue of information asymmetry, right? You know more about your company than the market does by orders of magnitude, right? They don't know you, right? But the market participants often know the market much better than an individual entrepreneur does, right? In terms of the big picture market, the deals, the M&A, the kind of the how that process happens. So there's a information asymmetry gap, right? So the more of that exists, it creates risk to both sides. So again, the more risk, the higher perception of risk, the lower the value, right? So one thing that we always want to be able to do is develop methodologies to minimize that information gap. That means educating yourself and having people on your team that can understand the market, et cetera, and also being able to present the information to calm the concerns of the investors, the M&A participants who are getting to know your company, right? You want to be able to present to them rapidly to where they can gain confidence fast in who you are, what are your numbers, what are the trends, where's the projection, why, etc. So just the kind of important slide there. So business valuation, again, a little more of the fundamentals. And really, there's a slide I love. It's business valuation is not accounting. It's kind of, I mean, it's definitely more finance than accounting, but it's kind of where everything meets. It meets in the now. Where are we, or at a specific point in time, right? And it's where the past and the future meet, which is the present, right? So all those factors will be taken into account as your company is valued. So as I have a little table here, time frame, and there's that art and science component of valuation. And I'm a numbers guy, but I'm also a story guy, right? Qualitative guy. So there's a reason why I'm in this business, and that's kind of it. Where this stuff all meets together. I find that there's a lot of interesting concept, and it's enjoyable. So hopefully that comes through to you all. But time frame, history here, valuation as art. This is the qualitative story of the company's history, right? You should always be able to tell that story of, well, how was it founded? How did you become an expert and be able to build? Who is the management team? How did you guys all come together? What is your business? What is the moat? How have you developed it, right? So being able to tell that narrative and that story. And then on the science side, right, the historical financial results of P&L. When you're really just getting off the ground, just kind of the numbers on the books, maybe it's an afterthought. But over time, you are going to have to be able to have those numbers be incredibly reliable if you want to maximize your value in the marketplace. And again, that's reducing the risk perception in the minds of investors, right? So that's why companies that have debt or have investors or go public have audited financial statements, right? It's creating confidence in the financial data, right? Reducing risk, reducing perceptions of risk, really reducing risk, but it also reduces perception of risk, which again is going to elevate values, right? So that's kind of history. The current example is, who are your current people? Who is your management team? What is your product offering? How many products do you have, right? Who are your current customers? Can you put together a customer list rapidly and show, okay, here's our customer concentration, et cetera. So having that little snapshot in time, real-time data as you grow your company. I mean, we're all living in a digital age, right? As you grow your company, it will pay off to make investments in having real-time data at your fingertips on all of these areas. So it's also example as far as the numbers, right? Current balance sheet. You should be highly aware of that. You shouldn't, try not to have lags in your, monthly reporting. You don't want to lose sight of where working capital is and fall into a financing, problem that becomes more difficult to get out of. Snapshot of as you go point in time to the market, M&A, the LTM adjusted EBITDA is going to be a critical, data point. So again, that is maybe the more mature companies a bit, all right? Where the startups, we're looking to kind of grow revenues, and we're looking forward to being EBITDA positive. But when you go to market to sell your business, that adjusted EBITDA is going to be an important one. And in the future, obviously, a very interesting place to examine, and that's where most of us stand here as early stage entrepreneurs. What are your future plans? What is the development plan for the technology? What technology is in process versus already, being beta tested in the market? What's your overall market strategy? What's your people strategy? Who would be your next 2 or 3 hires if and when you get this capital infusion, right? Being able to have that plan off the shelf is going to be critical for maximizing value when you go into a potential investment round, or obviously when you are looking to potentially sell the business. Additionally, too, on the numbers side, right, the science side, and yeah, the future, it's hard to be scientific with the future, right? Science is more of a real-time or past exercise. But, in terms of numbers, 5-year projected financial results, what would your numbers look like based on various discount rates, right? As we look out in the future, being able to develop and tell a story of where we believe the numbers can and will go. It's an important part of the process. So ultimately, again, bottom line here, business valuation, right, is driven by evidence-supported perceptions of the future. So the longer of a track record you develop, especially track record of success, you're developing a perception in investment community in a market that, yes, this business is capable of doing what they say they are going to do. And therefore, we don't believe it's as risky, and the value then goes up, right? So in terms of kind of fundamentals, what fundamentals will investors and the buy side analyze they value a business, right? So as you go through any due diligence process, these are going to be some of the core business pieces that are analyzed, and this is very agnostic to industry. I know we probably have folks from all kinds of industries, all type of company, business models, etc., on the call. So I've tried to make it agnostic, and it really is, right? When you come to finance, ultimately there are industry specifics, obviously, but there are many pieces of the puzzle that exist no matter which business you're looking at. So one here is financial performance. Again, the historical financial evidence. You want to be constantly developing that ability to have numbers ready, sound, not errors in your numbers. The more issues there are in the books, right? You look historically, that's going to ding the value, right? Because it will change the perception from the buy side, the investment side of the business and how well put together it is. It will elevate the perception of risk, which again, simple equation, right, brings down the value. So you really want to have your historical financial data in order, clean, crisp. I know it's 100 miles a minute, right? You got so many things going on, these numbers, right? But you want to get that right because foundationally, it's going to paint a picture of the risk of your business. And the last thing investors want is just kind of uncertain financial risk, right? So have that in order. That's going to be number one at all times, right? Financial due diligence is the primary due diligence. Two here is growth opportunity, right? Telling a story. This is the heart and soul of your business, right? Financial performance, maybe it's the bones, the skeleton, but the story is the soul, right? Where have you been? Where are you going? Why is it a compelling investment opportunity? What is the total addressable market for your business, and how have you kind of developed that? How are you going to capture share of that addressable market, right? So being able to get buy-in again to what your future growth story is here. This story, it goes hand in hand with financial performance, but it really goes more hand in hand with a projected future financial performance storyline. So again, we want those to be very well aligned. We want it to mesh and not be gaps in the story. Three is around capital needs, timing, and management of the capital, right? Most companies, most entrepreneurs on this call, I'd venture to say, are operating at a cash deficit, right? Burning capital. So really being able to talk about and present and have, financial planning around what are the capital needs? How is this capital going to be used and well shepherded properly to maximize ROI? These are kind of understanding that, knowing it, being very detailed around it will be important to the kind of demonstrating that you're going to be a proper shepherd of capital from the marketplace. So really understanding, being able to speak to the timing, and again, the why. How is this capital being used? Is it R&D? Is it sales? Is it actual CapEx? I'd guess probably most of the group here is low capital, not kind of building out factories and whatnot. But sometimes there are actual CapEx needs. So understanding as well your working capital timing. When are you getting paid? Are you getting cash up front for a contract, or are you invoicing upon work being completed, right? So we want to get cash up front if we can, pay bills a little later when possible. But understanding kind of working capital management is maybe not as big picture of an item, but is an important kind of management item. 4 here, minimize dependence. And this is, it's great to get the big customer, and maybe pre-revenue, getting that first customer might be the biggest milestone of the year, right? So depends on the stage, but as you grow and progress and have got over the hump of revenue, you want to maximize your customer list, right? You don't want to have 80% of revenues in one customer. That is a risk factor. If that customer decides to head elsewhere, I have a client that does shipping products, and they lost one of their biggest customers, and it was about 45% of their revenue. So it's a big hit, right? If you lose that one customer, the big customer is great, but it's also a risk. So diversification of the customer base is important. Similarly, supplier, and we've heard more and more of this over the last 12 months, last 12, 18 months, really since COVID, I'd say, is the supply chain, right? If you're reliant for all of your items on one supplier and that supplier goes dark or have a COVID outbreak or natural disaster or gets acquired by a strategic competitor, what just happened to your business, right? So you want to be able to diversify your supply chain. Again, that is becoming more a part of the conversation at this time. And hopefully that calms down, but it's really important and not one that's as focused on often as the customer side is. Also on the employee, and this might be you as entrepreneur, you're not really an employee, but you are ultimately if you're operating, substantially in the business. So being able to spread out the responsibilities and have the ability to have overlap. If there's one or two or three key people that if any one of them, went out, that the business would be at risk. That's a major risk factor going forward. And that will, again, simple equation at the beginning will bring value down as a risk. Also on a delivery model, again, we saw that again with COVID, if you're on-premise restaurant and you had no other way of selling and the restaurants get closed down, what just happened to your business, right? So it's been very obviously, we've all seen it with the Uber Eats of the world, Grubhub, right? Different delivery models that have become a business in their own right. But certainly kind of sales channels, right? If you sell, only via Amazon Marketplace, you're at risk, right? So just think about how does your product get to market, and are there multiple ways to get there? Some of the additional elements that will be analyzed is revenue, recurring revenue. Is that a one-time purchase, and then they don't have to buy anything for you for 10 years? Is that a multiple time purchase? They're coming into your shop, every day to buy coffee, right? Or is it, and this is gold standard, contracted revenue? We have a 3-year contract with auto renew, right? The more that revenue is contracted, consistent, reliable, low churn, the higher your multiples will be. The lower the risk is, so the higher the value, right? So we always want to be thinking about making sticky revenue where possible. That'll maximize the value of our business. 6 here, market differentiation and resilience. Are there 100 competitors to what you're doing, and anyone that wanted to start a business could jump in there at any time? Or do you have some patent protection and a very strong IP defense, and you're doing something that no one else has ever done, and there's a clear market need, right? So being able to defend IP or defend your market position, very important and will very highly impact multiples. Additionally is resilience. How, and we see it right now, right? I mean, it's interesting economic times. We have inflation hitting. We have obviously now the Fed raising rates. The economy is still strong, but obviously some headwinds, some geopolitical issues. So is your company going to be resilient, or will it only be successful when there's a very strong economy, right? So thinking about what will happen if there are twists and turns in the economy or a recession. Will my business be able to weather that storm or even grow, right? We saw some companies, the packaging company I mentioned, they really grew as a result of COVID. They started selling to the food delivery services, so they were able to double their business during COVID. So think of, okay, if there is going to be a change or a downdraft, how do I actually maximize that by taking advantage of that opportunity, right? Every challenge, there's also an opportunity. So just being resilient and not being totally dependent on a strong economy, very important. Seven here, customer satisfaction, brand strength. I have a story. I had a former client. They were called FaceTime, and they actually sold their brand to Apple for $40 million. So the FaceTime, app that you use, many of you probably use every day. That brand, that trademark was actually acquired, and I had a former client that used to be called FaceTime. They changed their name. Their backup name to that was not nearly as strong, but they did get 40 million with a non-dilutive payment there as they were a growing company. So, pick a great brand, defend it, take care of it, right? Customer, the voice of the customer, very important. Poll your customers. Understand, you might be in beta, right? Get very close. Understand what your customers need. I do have a client, I spoke about customer concentration, but I have a client, they're very successful, closely held business, and they do have one customer that's 80% of their revenue. And now if this guy went to sell, he would get beat up over it, but he's not selling his business. But he's deeply embedded with one customer. And it's almost more like they are a part of each other. He's so embedded that even though it's a risk to have the 80%, he knows what his customer needs so much that they really couldn't get rid of that business, right? So understanding your customer, being really embedded with them, kind of gauging their wants and needs, using that to develop new products, right? Very important. And then your brand, really taking care of it, being very proactive on the customer side, right? Amazon built their whole company based on just the customer, right? Like what can we do to make it more simple, easy, convenient, make our customers happy, right? So always thinking about very customer forward. And then 8 here, again, minimize dependence on any one key person, right? Just highlighting that because we're entrepreneurs. Many entrepreneurs are like high achievers. You kind of want or think, or maybe you really can do a lot, right? But also you do need to get a great team, right? To maximize your business value, you need to have a great team. So that's definitely one thing to just keep an eye on. And again, if it's all on you, that's a risk, right? Even if you're the greatest ever at what you do. So these will be the primary factors that investors will look at. There are obviously others, but this will cover 85% of what they'll, big picture, what they'll be looking at. One thing here is kind of developing the ability to manage towards a higher valuation. So again, the valuation is kind of a point in time, right, where you meet the market, or if you're getting just a valuation engagement done, issuing options or doing something where you kind of take a snapshot, right? But ultimately, your business value trend is a process. And it really is a managed process, right? You have to do very well at your core, but also managing the business effectively to consistently progress your value upward. And that, again, is just kind of baking in. I'll circle back to the initial slide with the simple valuation equation, right? Perceptions of future cash flow, perceptions of risk. So if that's always just a part of your day-to-day, then as you make decisions, your incremental decisions day by day will increase your value, all else being equal. So it's simple practices like, eating your vegetables, drinking water, getting enough sleep, right? But it really does pay off substantially. So 4 components really for this, optimize and improve your business cash flows. That's obviously a challenge early on, but get to revenue, right? So if I set back another layer, sell, develop. You guys already know that. I don't need to tell entrepreneurs that you need to develop a product and sell the product. But once you're kind of getting there, then it's kind of being smart, optimizing, improving business cash flows. And then again, this is the storytelling, the future projection, kind of making it believable and improve the perceptions of the future cash flows. And then optimize and improve risk mitigation and improve perceptions of future risk. Everything that you're doing, and if you're doing it right, will flow into one of these buckets. So if it's constantly cycling into there, again, that valuation trend is going up. The valuation is not based on magic. I mean, sometimes you might get lucky or unlucky based on what the market is doing, right? But the fundamentals of what's happening with your business to these 4 buckets and that one simple equation is where the valuation will go up. So it is pretty simple, right? It's not, but it is. This is just some data here, and this is around the rate of return. And this is venture expected rates of return. And what this is, again, is it's a measure of outlook risk perception. So your projection risk. And they decline by stage. And what this is really saying, right? So this kind of is going to say what I've been saying, but in a different way. And you see the stages there. You see startup, early development, expansion, bridge IPO. The rates come down. And these are all based on various studies. I have the footnotes here. But this is kind of academic stuff. I don't want to get too technical on it, but rates of return, which is a measure of risk, decline by stage. This means as you kind of stack the bricks and you build the foundation of your company, not only will you make it more profitable, which will naturally, or not just profitable, but grow revenues, right? Hopefully profitability is coming into the picture at some point, but you will stack there. But also the risk comes down as you kind of achieve your milestones, which further accelerates the value because the perception of risk in your business is coming down, right? And so I'll show you a little exercise here in a minute. But as the rates of return that are expected by the market for your business come down, really leverages the value of your business. If you do a valuation exercise with Apple, I'll circle back to Apple. If you do a valuation exercise with them, kind of the rate of return that spits out of there is like 5%, right? Very low percent. Like basically the market says, Apple, we believe in you that you're going to keep churning out cash. And you have a low risk business, right? So folks that are starting a startup, that you haven't sold any products and you have zero, maybe you're just in the garage somewhere, right? Your rate of return for capital is going to be very high because you have to do every part of the validation process, right? So the goal is we want to get to that next level of the development where the risk perception is lower and then hence the valuation is higher. So again, I'll get to a little mechanics of that here with a quick exercise here. So this is some of the numbers, and this is, we could dive into the weeds of this stuff. This is what technical valuation guys like my team and I have to do all the time. But this is a DCF analysis, and you see there's 3 highlighted segments here. And if you want the PDF of this thing, request it from Colin Cody. They'll hand it to you. You could kind of dive in, but I just want to walk through. This is a projection, kind of just a model projection, right? 1.5 million. I kept all the revenue the same. There are going to be 3 scenarios. Kept all the revenue metrics the same. So we start off humble. We're here 1.5 million. Maybe we have a couple customers in 22, but we really believe we can ramp. We can more than double in 23, and then we can double again in 24. And then as we work out, we start to get a little more conservative with our projections and ease up the growth rate. Similarly with the gross margin, right? We might start a little low, start a little meager, humble, but as we accelerate, as we expand, that we believe that we'll be able to kind of expand that gross margin as we generate efficiencies, et cetera. And then similarly, as we manage our resources well, our EBITDA, right, we'll gradually get to that profitability. So in this case, you've put together a 3-year projection. The financial side is kind of assessing an extended number here based on their belief in you, right? How profitable will this outlook be, right? So in this case, profitability, we get up to 20% normalized EBITDA margins. And in this case, I've used a discount factor of 45%. If I bounce back, right, let's call that early development. So there's maybe not quite startup, but early development stage. 45% discount factor, cash flow adjustments here, terminal value based on not a multiple, but kind of an implied multiple with a 20% kind of post valuation discount rate. This scenario spits out to a $6 million enterprise value here. So about a 4x 2022 revenue, right? So that's example 1. Maybe not the highest perception of future profitability, definitely a high perception of risk, 45% discount rate, right? We talked about Apple is down at 5%, so 45% is, there's a lot of perception of risk here in this business. Again, that came out to 6 million. So fast forward to scenario 2, right? Again, focus on the gold boxes here. So we have 1, we have 2. In this case, the perceptions are stronger that you're going to be more profitable. So each phase, each year is a 7.5% higher EBITDA margin expectation in this projection. Same discount factor, still a high perception of risk, but just with that, nothing else. You have revenue top line the same, gross margin the same, just EBITDA, right? 7.5%. That bumps us up to 8.4 million valuation, right? So about about 20. I guess that's about 30% higher, and that's just with a bit of EBITDA expansion, right? 2.4 million, giving up less of your equity, substantial valuation step up there. Scenario 3, and this is the big lever, right? Same. So scenario 3, 2, and 3, right? All financial metrics the same. The only difference here in scenario 3, discount rate. So we're more believable, right? The market says, okay, risk, we believe in this projection. We're not going to apply a 45% discount rate. We'll get down to 25%. Still high. Apple's at 5, right? A lot of companies are 10 to 20. But 25% are still relatively early stage. You see what that does? It gets us up to 11.8 million. So it's almost double that initial 6 million valuation, right? So this is up there to 8x of 2022 forward revenues, and that's a place you want to sit. So right there, it's believability. It's reducing the perception of risk. Reducing the perception of risk substantially, changes the valuation. So I just wanted to unpack some of the mechanics, right? We talk about the concepts. This is the numbers. Every finance organization globally is going to have folks in their back office that will run analytics and run DCF on their investments, right? My sister-in-law works at private equity. This is what they had her doing when she was in her MBA internship. She was doing DCF analyses on all their targets, right? So if you have to understand some of the mechanics, but you don't need to know maybe all the nuts and bolts. Hey, if you figure that out, you'll be that much more, skilled in finance, but you don't need to do that as an entrepreneur. But you do need to know the big picture, right? Obviously, we need to grow revenue. We need to expand the expectation of profitability. We need to bring down the perception of risk, right? Those simple levers will make a valuation go from 6 million to 11.8 million with the same exact 3-year projection. Remember, this 3-year projection is exactly the same in all scenarios, and it goes from 6 million to 11.8. So that's based on perceptions of profitability, perceptions of risk, right? So here are some to-dos to strategically expand value, right? And these are to-dos beyond, again, you don't need me to tell you to develop your product, sell your product, right? That's fundamental. That's what you're doing every day, all day, as you start up and early develop your business. This is more of the finance side, right? I'm a valuation guy, branch of finance. As you develop an organization that will support successful finance and meet the market successfully. One is to develop and recurringly update a 3+ year high level projection. So if you notice in the prior exercise, again, the first 3 years are all exactly the same, right? As I scroll through it, exactly the same. That's the entrepreneur's projection. You should have a 3-year projection at all times, right? And do you need to update it daily? No, but every quarter, every 6 months, every month, do have some recurring process of relooking at your projection, right? Doing that will create your own guidepost, and then you can kind of analyze, like, why are we, if you're not meeting your original projection, why are we not, right? If you start asking the questions, are we, did we not, get as many sales as we expected? Was our product slower to market? Did we have some bugs? Or maybe you accelerated, boom, we got 5. We expected 3 customers, we got 5. We thought it would take 6 months to develop the product, but we were able to squeeze it out in 4, right? So kind of being able to know and understand, and then being able to kind of navigate based on that projection. And then again, that projection is going to bake into the valuation process substantially. And then also being able to speak to that projection, right? Perceptions of risk, the investors or the buyers that talk to you. And if you could talk about your 3-year projection in great detail, they will believe you more. than if you just don't. Oh, what do you mean? Yeah, we don't look through more than the next day, right? I mean, again, should you be focused day to day? Absolutely. But also, you should have that big picture. You should be able to speak to it, and especially when you have those moments where you're meeting the market, right? So, yeah, that's a homework to-do list. Develop and update the 3-year high-level projection. You don't need to get super granular. If you do, great, but definitely revenue, gross margin, EBITDA margin, and then your kind of CapEx, working capital expectations. Those are really important. Bullet point 2 here, understand your comps basket, right? So what are the public companies that you would be compared to, or in, as you mature, like what would be our kind of aspirational, what would we look like by business model, right? Understand those public comps. Keep an eye on them, what's happening in the market. Know their margins, right? Know what their CapEx requirements are. These type of things will be informative to you and to your projection, right? 2 is deals, right? If you see, keep an eye on deals in the space. You should be having, try to have a bit of a database and understand kind of what's happening. Again, the further you out to it, does it matter as much? No, right? But the closer you get to a meeting of the market, it's important to kind of know where the market stands. And then 3 is private rounds. These can be a little tougher because public companies obviously have to report quite substantial data. Private companies do not, by rule have to. But you can find data, and reach out to me, right? I had a client that actually met through the Nasdaq Center. A couple clients that we've had that have reached out and want data on private rounds. We helped a gentleman recently develop his pitch deck, and he is a substantial information in his space, very early stage. But databases, PitchBook, Crunchbase, get an understanding of your space and your comps bucket. Bullet point 3 here: routinely refine your pitch deck. I've had several clients that I've coached where they send it along for us to look at and give feedback. You should constantly, if you only do your pitch deck at the time that you go to market, it's going to add anxiety, it's going to add stress, it's going to be a bigger exercise at that point in time when you already have a lot to handle, right? So if you kind of make it more of a routine, that your pitch deck is constantly kind of being upkept, then you're ready, you stay ready rather than getting ready, right? So that should be a part of who you are. And that story, again, the believable story, and then also the story starts to become part of reify as part of your DNA, right? So it becomes a virtuous cycle. So don't just do a pitch deck, the month before the deal. Have a pitch deck ready and upgrade it all the time. Next comment here, total addressable market. If you can't speak to it, you won't look serious, in the investment, situation. So, I know it can be very challenging. Bottoms up, top down research studies, third-party research, right? Get as good of an understanding as you can of your TAM and have a way to speak to it, be believable, etc. It will help you maximize the value. Again, it's the perception of risk. If I'm an investor and I, ask a potential entrepreneur, what's your TAM, and they say, oh, we don't know. We're trying to figure that out, right? Is that the risk perception is higher? If you can break it out, or it's a part of your deck and it's built up, top down, right? Believable, lowers the perception of risk. Remember the valuation number, 6 million versus 11.8 million with the same 3-year projection based on a risk perception, right? So be believable, do your homework. And then here, key people, continuous improvement, and data enabled. These are 3 key buckets, right? You can't just do it all yourself. Yeah, again, think of the 2 or 3 people that you would hire. When you get that capital infusion, have that list ready to I'd hire a finance person, I'd hire a salesperson, I'd hire a VP of R&D, right? Have those ones ready, and expand that team where possible. You need a great team to be great in business. Continuous improvement. This is just incrementally improving. This kind of circles back to the pitch deck. It's easier to just incrementally make something a little bit better than it is to do something of a heavier lift at once, right? So the more you can incrementally improve continuously, you will see great things happen over time. And then 3 is just, again, data enabled. You really want to have that real-time data, and there's probably 90% of this group is probably better with technology and apps and stuff than I am. So absolutely, I would expect for you all to be crushing it on your data, analytics, KPIs, etc. Where are we at? All right. So just kind of theme for business leaders, and again, this aside from the always be selling or always be developing, mindset, which is where you do kind of have to live as an early stage entrepreneur, but to really maximize valuations, right? To maximize that point of valuation. Again, you want to provide investors with a clear vision of a profitable future. Easy to believe that, wow, this future is going to manifest itself. Right? And it's more believable with quality evidence and data. So the more you develop that, both with your specific, again, evidence, your historical financials, your data, your very well thought out, well developed financial projection, right? As well as market data. Again, the total addressable market. Who are the competitors? Who are the comps in your space? Why would those margins be reasonable based on evidence that we could see out in the marketplace, right? So I had a buy side or investment side client who was looking to invest in, there's a Japanese client looking to invest in the United States into a startup company. This was back when the secondhand apparel apps were really kind of blowing up, and the company that they were looking at had a projection that was just totally unrealistic, right? Just not in any way near what other market participants that were public would show for profitability, et cetera. So really, we just had a haircut. We had to kind of almost throw out their projection and do it ourselves. Like it wasn't realistic. And not only did it impact how we assess the projection, it also circled back to the assessment of management themselves, that if they would present this to a potential investor, serious investor, it kind of speaks to their seriousness as a management team. Right? You don't want to be off the rails and then now you're presenting yourself to the market and you're not taken seriously. Right? So if you ever have a question like, is my projection even like within the realm of feasibility? Like, one, ask yourself that question. You kind of relook at it. 2, always available here. You can reach out. Happy to kind of give you some market participant perspective. But again, you want to be able to, that circles the next point, a supportable, well-told story. You don't want to tell like something that's obviously a fairy tale. You want to tell a real story, supportable, well told. You want that discount rate in the minds of investors to come down. That's kind of the nuts and bolts of it there. And then 3rd is obviously the secret sauce, right? You want to be able to know, defend, speak to, go on and on about your secret sauce. That really obviously is, again, I don't even need to really be saying this to this group, but you want your secret sauce to stand out. And then at the bottom point here, convince investors of reduced risk. That's what I was speaking to earlier, with a realistic projection, with your story and the data, aligning, really telling the same tale, and not having gaps in kind of your diligence stack. Again, being prepared with your pitch deck in advance versus slapping it together last minute. Utilizing mentors or other resources or partners that can provide third-party feedback to you. Right? You're going to be the expert at your business. You're not going to be the expert at parts of the process. Right? So have the right team, have the right advisors, have the right folks that are on your side to help you. Because ultimately, like the capital markets, right? It is a form of a battle. Right? We want to be on the same team. But there are 2 sides of the table. One side wants it high, one side wants it low. You got to defend yourself. You got to have your ducks in a row to maximize your side of that, right? So having the right team, having the right preparation. Again, I'm a coach, right? Being prepared, doing all practice, and you go into the game and you execute, right? So you always want to be prepared. If you just show up for the game, it's not going to go well. So all these type of things, being prepared, getting after it, having the right team around you. Again, some of the foundational fundamental, jumped ahead real quick. The foundational, right? Let me go back to my equation right here. Perceptions of future cash flow, perceptions of risk. Always be working towards maximizing the future cash flow projection, minimizing the perceptions of risk, your valuation will step up. So yeah, that's the gist of it. Bonus slide here, definitely, maybe that, demystifying valuations, but also I'm very, because people matter. That's the business I work at. That's me. This is kind of a little more philosophical, but also business related. Japanese concept of ikigai. And it means a reason for being in Japan. And if you haven't looked this up, check it out. I refer back to it all the time. 40-year-old professional, but I need to be refreshed as well. And this helps give me balance, refreshment, passion. So yeah, it's just, what are you good at? What do you love? What the world needs and what you'd be paid for. If you kind of fill all boxes, it'll be a great success. So yeah, a little bit off the board here, but look up Ikigai. That's a little bonus slide. And at this time, happy to take Q&A. I see chat. I see Colin bumping back in. Happy to answer any questions.
Kemp, you rocked it, and we don't have too much time for Q&A, but really appreciate everything that you shared. And yeah, I have a Post-it with Ikigai on my computer monitor. So
nice.
Definitely heard of it, definitely back it.
Yeah.
A bunch of people are asking about the DCF template in Excel. Would you be open to sharing that with the squad? I know you're open to sharing the PDF of the slides.
Possibly. So I would say on that, like, if folks reach out one-on-one and we kind of can establish some rapport, relationship, I'll be happy to do that. Just can't necessarily share out some of that's not the secret sauce, but some of the secret sauce. So I'd love to do it. If we can establish some relationship,
cool.
With folks there. Yeah.
Awesome. All right, let's try to run through some more. And then while I ask you a couple questions, I have just one final poll for our audience that will help us understand what they're looking to learn in the next couple months, but can't ignore that poll box. All right, so we got a question here around valuation of IP. So somebody had an interesting business scenario, sorry, anonymous attendee, but they're liquidating the LLC and planning to reach out to strategic buyers to sell their IP.
Yeah.
Any thoughts or advice on that?
Yeah, I mean, one is really get orderly around what it cost you to develop that, right? Like what and cost, and some of these costs, like you'll have the receipts and P&L expenses, right? But some of it might be your extra time, energy, effort. You want to maximize the value of that. So the more you can show, like, hey, here's our costs and here's also what we put into it, you kind of want to build up that value as much as possible. And also the amount of time that it took you, et cetera. There's some key levers: time, cost, et cetera, that you want to kind of put in the side from the buy side. How would they accelerate their time to market, and what would it cost them to do it? Those are some of the key factors there.
Love it. And then, we're so on time. Let me see which one is gonna be good. So somebody's heard that the rule of thumb for 409A valuation or 409As is valuation multiplied by 3 to 7. What's a benchmark on initial valuation for 409As?
Yeah, I'm not 100% sure what you mean by that question. Is that like a revenue multiple, forward multiple? I don't know, but really it's incredibly industry specific. So it really depends on what type of industry you're talking about. What is a revenue model, right? You might have distributors that have substantial revenue, but are taking a small slice of that pie. Their multiples are going to be very low versus a tech, SaaS tech company that has sticky recurring revenue that doesn't have really much cost of goods sold, right? So it's impossible to say a rule of thumb without at least knowing industry. And even then, even within the industry, there's not really a rule of thumb. I mean, there's some kind of semi benchmarks, but even those evolve. Like if you asked me that 6 months ago versus today, the tech space has really taken a hit, and there's been multiple compressions. So there's not a rule of thumb that just exists.
Yep. Well, Kemp, we are at time, and I really appreciate you sharing your wealth of expertise and knowledge with everybody in the audience. And I'm sure a bunch of them really appreciated you sharing all of that as well. So thank you so much for joining us again, Kemp. You continue to impress me with all of the things that you know. What's one takeaway other than Ikigai that you want to share with the audience today?
Yeah, I'll just say it's developing from valuation. It's developing the management of the perception the future perception for investors? Do they believe in you, and do they believe there's less risk? Right. That only happens if you really do it, but managing that perception will elevate your value when you go to market.
Love that. Well, thank you again, Kemp, and thank you everyone for attending. We look forward to seeing you in our upcoming webinars. Cody did drop some of LinkedIn and some more information on Kemp. So if you want to reach out for more questions, we've got that covered. But Kemp, thanks again for joining us. Always a great time to have you.
Appreciate it, Colin, and thanks everybody for joining today.
All righty, and for those of you still on, we'd love to hear from you. So we would appreciate some feedback to learn how this went, and then also what you all want to learn in the future webinars. But to all of you who joined us, thank you again, and we look forward to welcoming you all back online soon. Thanks again, Kemp.